We can categorize all the credit products using some of the criteria as follows. Long-term versus short-term sources of credit, privately sourced versus publicly sourced credit products, government-based sources versus non-government-based sources of financing, funded versus non-fund-based credit products, agreement-based versus instrument-based credit products, and secured versus unsecured credit products. Now let's understand each of these categories in detail. The short-term versus the long-term credit products are distinguished based on the tenure for which the credit is provided. In finance, short-term means 364 days or less, whereas long-term means 365 days or 1 year and more. So credit products that fund you for less than 364 days or 364 days are basically short-term credit products. These include products like treasury bills, which are issued by the RBI on behalf of Government of India, commercial papers, certificate of deposits, and any other kind of securities like bills or commercial bills. These typically finance the working capital requirements of a business, and they are typically secured against the short-term assets, or what we call as current assets, like inventories and debtors. The long-term sources of finance include, for example, government securities, which are in India 2 years to 40 years tenure, issued by RBI on behalf of the Government of India, the bonds issued by the corporates, and let's say a FD issued by a bank for a period of more than 1 year. Now these sources are typically funding the long-term projects or creation of assets, and therefore they are at times secured against those projects or those assets. Typically the long-term funding costs you slightly more than the short-term funding. The next classification is privately sourced or publicly funded credit products. The privately sourced products include, for example, trade credit, which is granted by a company to its customers, what we typically call as accounts receivable or debtors. This is of course negotiated between two parties. The company may grant you credit for, let's say, 2 months or 60 days and might charge you, let's say, 1.5% interest if you delay. Now these terms are strictly decided between two parties. So these are private sources of credit. Even private placement of debt, for example, we can call it as a private source of credit. So when it comes to private sources, the deal is negotiated between two parties, and certain aspects of deal, for example, the amount, the instrument, the yield, and any collateral, etc., is negotiated between two parties. As compared to this, there are publicly sourced credit products. For example, if the company comes out with a bond issue and offers it to the public through an offer document, then it comes under, let's say, SEBI scrutiny, and therefore the publicly funded products are scrutinized more closely by the regulators as compared to the privately funded products. Another example of publicly funded products is the auction conducted by RBI on behalf of government for, let's say, treasury bills as well as for the government securities. The public deposits raised by the non-banking finance companies or by the corporates after securing necessary approvals are also an example of public funding of the debt products. We can classify the credit products based on whether the government or the government agencies like the public sector enterprises are funding that credit. For example, the government itself might fund various enterprises like medium, small enterprises through certain schemes, and those are definitely the credit products that are government funded. The government also might fund through, let's say, public sector enterprises. For example, the oil companies, they might give certain advances, for example, to their vendors, which will help them procure certain material. In that case, it is the government indirectly funding some of the credit products. Typically, the government will fund these kind of products in the interest of the society at large or for creating the public infrastructure. As compared to this, there may be the non-government or public like you and me, or the businesses or the banks which fund the credit products. The examples of this also include the PPP or public-private partnership mode kind of projects, where a certain amount of funds are raised from the private parties, and typically at the end of the project or after a certain time after the project, the ownership of the assets is transferred to the public at large. In the PPP projects, typically the repayment of the funds which have been raised is made by raising certain tariffs from the people or user fees. Like for example, you pay the user fees for using airport, which is in the PPP mode, or you pay a toll for using a highway, which is constructed in the PPP mode. Another categorization of credit products could be, for example, funded or non-fund based credit products. Funded products are those products like term loans, working capital loans by the banks, where the banks have to actually have funds and give it out to the customer or to someone else on behalf of the customer or borrower in order to secure that product. Now, compared to that, there are non-fund based sources. For example, when a bank issues a guarantee on behalf of the borrower or the customer to a third party in pursuance of a contract between the customer and that party, the bank is not spending any money upfront. It is only writing a contract or a guarantee. Therefore, these are examples of non-fund based products. Other non-fund based products of the banks typically include letter of credit and letter of comfort. In case of fund-based products, typically the return is through coupon or interest. In case of non-fund-based products, the return is typically through commissions or fees. One more categorization of credit products could be whether they are agreement-based or they are instrument-based. Agreement-based products are secured through an agreement between two parties. For example, when the bank gives a term loan, a personal loan, gold loan, or a working capital loan, it signs an agreement with the borrower or the customer. In that case, the agreement is not easily transferable. Of course, the bank in its clauses does write that they can sell off that agreement, but since these are little bit non-standardized products, the bank cannot easily sell it. Of course, there is a way, for example, the assets are securitized and they are sold off. Compared to this, you have instrument-based products where, for example, the company issues bonds. The process looks similar, but it is different in the sense that instead of entering into an agreement with a particular bank, the company might place those bonds with that bank. Now, in this case, the bonds could be transferable in the market. So, the bank which possesses those bonds can easily liquidate and raise the funds. So, in case of instrument-based fundraising, the liquidity is high, whereas in case of agreement-based fundraise, the liquidity is low. One more way of categorization of credit products could be secured versus unsecured or not secured. Secured products are typically secured by, let's say, a bank guarantee, or maybe, let's say, a FD against which a lien is marked, or for example, the hypothecation of equity, hypothecation or mortgage of house, right? So these are called typically secured products. So there's a collateral against that lending, and you can possess back that collateral in case the repayment is not made. Compared to this, there are unsecured products where there is no security. You give it only on the basis of the credit appraisal and the track record of the borrower. Obviously, the unsecured products carry a higher level of risk. Unsecured products are therefore typically slightly highly priced. That is, the rate of interest or coupon on those products is typically higher. I hope with this you have understood the different categories or types of credit products. Of course, we will understand each of these products in detail in the subsequent series. If you did like this video, please do subscribe to my channel and also share it with your friends who might benefit from it. Thank you very much and cheers.